Equity financing has the definition of the act of raising money for company activities by selling common or preferred stocks to individual institutional investors. In return for the money paid, shareholders receive ownership interest in the corporation. Explaining this is when a company raises money by issuing stocks. The other way, the other way to raise money is through debt financing, which is when the company borrows money. As an example of equity financing, we have the story of beginning of the company Apple. Apple, to finance their expansion, had to sell stocks of the company, and this fact created the need of a board of directors. After some years and the success of the Macintosh, the board of directors decided that Jobs wasn't the ideal man as CEO of the company. In 1985, after an internal power struggle, the board of directors decided that Scully and Jobs was stripped of all duties. So, as everybody knows, one of the founders of the company, Steve Jobs, was fired from his own company. You can imagine how hard it was left behind most part of the work in his life. Now, the lesson is that you have to be careful by the time you have to choose the source of capital for your expansion, and you have to choose that one that attends your financial and philosophical needs.
Debt financing happens when individuals or investors lend money to a company and promise that the principal and interest on that debt will be repaid. Short-term borrowing lasts 1 year or less and is repaid from sales. Long-term debt are term loans of 1 to 5 years or long-term loans maturing in more than 5 years, and they are used to finance the purchase of property or equipment with the purchased asset serving as collateral for the loans. The most common sources of debt financing are commercial banks. Types of loans that are offered by commercial banks include short-term loans that are secured by receivables, inventory, or other assets, intermediate loans with maturities of 1 to 5 years, and 90% of these loans, banks require collateral such as stocks, machinery, equipment, and real estate. They also require repayment over the life of the loan. And third is commercial banks offer few loans greater than 5 years. Entrepreneurs need to answer these questions to secure a bank loan. What do you plan to do with the money? How much money do you need? When do you need it? How long will you need it? And how will you repay the loan? Another way to finance a long-term loan for a piece of equipment is to go through manufacturers who take a portion of the purchase price in form of a long-term note. Advantages of debt financing include there is no relinquishment of ownership is required, there's more borrowing which allows for greater return on equity, and low interest rates reduce the opportunity cost of borrowing. Disadvantages of debt financing include monthly interest payments are required, cash flow problems can intensify because of payback responsibilities, and heavy use of debt can slow growth and development.
Angel investors are wealthy individuals who invest in high-risk, early-stage ventures. They reserve a portion of their investment portfolios to provide emerging companies with seed and startup capital through direct and private investments. Their goal is to achieve higher returns than the typical public markets provide. They invest more than $25 billion a year to 50,000 to 60,000 companies nationwide. There are 5 types of angels: corporate angels, entrepreneurial angels, enthusiast angels, micromanagement angels, and professional angels. Corporate angels are typically senior managers at Fortune 1000 corporations with early retirement or are laid off with generous services. They may be persuaded by the entrepreneur to occupy a senior management position. Entrepreneurial angels are the most prevalent type and typically own and operate highly successful businesses. They tend to take bigger risks and invest more capital with additional income and wealth from IPOs or buyouts. Enthusiast angels tend to be 65 years of age or older and are independently wealthy. They invest as a hobby and tend to invest in small investments and spread across multiple companies. They really like to be involved in ideas. Micromanagement angels are very serious investors. They are dangerous because they're most likely successful in building a company and attempt to impose their tactics that work for them. Professional angels are referred to investors' occupations who are doctors, lawyers, or accountants. They invest in several companies at once and are likely to invest in companies that offer a product or service which they have some experience in. The pros of investing in an angel investor is that they engage in smaller financial deals, that they prefer seed or startup stage companies, and they are generally interested in the entrepreneur. The cons of dealing with an angel investor is that they offer no additional investment money, they cannot offer any national image, they lack important context for future leverage, they may want some decision making with the entrepreneur, and are getting more sophisticated in their investment decisions. The funding process when dealing with an angel investor consists of first the self-assessment, then the online application, the screening meeting, the presentation to membership, due diligence, term sheet negotiation, and then funding and beyond.
Venture capitalists are professional investors who invest in business ventures, providing capital for startup, early stage, or expansion businesses. They are a valuable and powerful source of equity funding for new ventures. They provide a full range of financial services for new or growing ventures. They spend a great deal of time weighing risk, and they measure the stats of both the product or service and management. Investments from venture capitalists in 2011 are aimed more toward early stage and later stage business ventures. Startup or seed companies don't have much luck with venture capitalists. The 7 major trends that come up when dealing with venture capitalists are: 1. They are shifting toward investing with pension institutions or more experienced firms. 2. Innovation has become more global and many venture capitalists have opened offices in China, India, Israel, and Vietnam. 3. Funds are becoming more specialized and less homogeneous. 4. Syndicated deals are emerging. 5. Small startup investments have weakened over the last 10 years. 6. The industry has become more efficient and more responsive to the needs of the entrepreneur as a result of greater professionalism and competition. And 7. There is a stronger legal environment. Equity financing, debt financing, angel investors, and venture capitalists all lead to one thing: money, 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 money.